Time now for our daily look at the commodity sector. Let's bring in Andrew Bell, who is looking at some of the hot topics in commodities right now. And take your pick, Andy. Everything is on fire today. Let's kick off with oil, because there are widespread hopes in the oil market that this return to travel in China for the New Year's celebration, the Lunar New Year celebration, will see massive use of fuel. Our Bloomberg partners citing estimates that 2.1 billion trips may be taken. And of course, traditionally, they crowd airports, highways, you name it. Although apparently the level of travel in China this year will be only about 70% of what it was in 2019, just prior to the pandemic. So it's still not back to where it was. Let's have a quick look at the great rebound, though, in the oil market. You can see, Amber, demand collapsed early in the COVID pandemic. Supply took longer to come down, but it collapsed as well. But we're essentially back in terms of supply and demand to where we were in 2019 globally. Here's an interesting phenomenon. It comes from Rory Johnston's commodity context. Let's have a look at the surplus deficit in the oil market. And we did. Obviously, when demand collapsed, we moved into a massive surplus. But then we ran, for more than a year, deficits in terms of daily supply. We have been seeing the market slip back into surplus lately. That could be a bearish sign. We're joined now by Rory Johnston of Commodity Context. Rory, thanks very much indeed.
Thanks for having me, Andrew.
Rory, just very quickly, I mean, is that important that the oil market apparently going back into a surplus?
Yeah, and I think there's a couple things to note here. Like you were saying, so we went from this like all-time high surplus in the market during COVID, then this really, really long protracted period of not just deficits, but really, really large deficits. And that took those inventories globally from record levels, coming out of COVID, all the way back down to a level that we hadn't seen since like 2010 to 2014 period, when everyone thought that oil was scarce and prices were above $100 a barrel. So that's the kind of situation we find ourselves in today. And then we started this year, we started climbing, things looked really tight, and then that peaked right around June. And what you can see in that chart is right around the middle of the year, things started weakening. And that was mostly because we just didn't get those supply losses from Russia that we were expecting. And even more acutely and more kind of immediately, we lost so much of that demand from China with COVID zero lockdowns, like you alluded to in the intro. So, the way I see it right now is I don't see the market as especially strong. But I think that actually, for people that are bullish oil, for instance, I think that you should actually take that as a bit of good news in some ways, because if the oil market was stronger fundamentally and prices were still where they are right now, that would be much harder to kind of make a compelling case for. But I think going forward, you can make the case that we do lose more Russian supply, or we do get a bunch more Chinese demand back that pushes us back into those deficit conditions. And I think, remember as well, those inventories are now exceptionally low. So we don't have really any buffer either. So the next period of deficits are that much more kind of price positive, if you will.
Rory, can we talk about calendar spreads? Now, it gets a bit technical here, but this one of the phenomena people watch out for in the oil market is whether oil for near-term delivery is trading at a premium or not. And when it is trading at a premium, that is a sign traditionally of a tight market. But what's been happening lately? And what does this chart show? What is the calendar spread?
Yeah, so the calendar spread, and the one showed here is just basically the prompt price, so the price you see on the screen that BNN is kind of intermittently putting on the screen, and then the 12th or 13th month contract down the curve. So it's the 1 year spread. Okay. And like you were saying, a premium for spot prices means the conditions are bullish in the market. People are paying a premium to get things today rather than waiting for them later. Inversely, if you had prompt prices or spot prices at a discount, that's when you have a really, really loose market and you're actually incentivized to build inventory. But I think what that chart shows is that you saw as prices climbed through the first half of the year, particularly through the first quarter, and those calendar spreads ratcheted up to all-time high levels. We'd never seen calendar spreads so tight. And I think that was very indicative of just how tight that market felt at that point. But I think the other thing that this tells you, and kind of commensurate with the previous supply and demand chart we looked at, was this isn't just a speculative driven sell-off that brought us down from where we were in June almost half that level by the end of the year. I think that's that point that, it's not just speculation. There was a fundamental weakening of the market, and that calendar spread also fell off from record all-time levels to, much, much more modest levels. So I think that the market's still building in some tightness there. And I think that's largely precautionary because, again, a lot of things could go wrong in this market. But I think, you see in the calendar spreads that there was fundamental conviction as well as just kind of price movement.
Rory, can we move on to refiners' profits? This is a longer chart. It goes back to 2010. But I think it points to how refiners earn massive profits in some products as we moved out of the pandemic.
Yeah, so the other thing that happened through the pandemic, so a lot of people only focused on what was happening on the oil side, the crude oil side. And what you saw throughout the pandemic was that the refining market actually in many ways, exhibited and underwent an even more kind of historic transformation. Because what you had for a long time, the refining market was really, really sleepy, quite dull, honestly. Not a lot was happening. Things were really slow moving. But when the pandemic happened and all of these fuel prices completely collapsed, a lot of these refineries, particularly in North America, they were on their last legs. A lot of these facilities were 100+ years old. When those refineries, were given the option of like, okay, do you really spend some money now and batten down the hatches and wait for things to get better? Or do you just accelerate your retirement of your entire facility by a couple years? A lot of operators took that second option. At the same time, refineries that were supposed to be coming online during that period, in India and China and the Middle East and into Africa, you definitely just didn't see that happen as quickly because of all the supply chain bottlenecks, all the mobility bottlenecks that we saw through COVID. So that, created a deficit of effective or high complexity refining capacity, which, in turn, really caught the market short of diesel or middle distillates. And that's why we've seen diesel prices just absolutely astronomical this year. But at the same time, as all of the rest of the refining fleet globally, things that were much less sophisticated, things honestly like a lot of the refineries that we see in Mexico, as they ramped back up in order to capture that diesel spread, they actually spit off a bunch of other byproduct fuels like fuel oil, and that oversupplied those markets.